Just the concept is the so-called fakie, and some people may refer to it as bull traps, bear traps, failed breakouts. And technically what you want to do is you look for either long-term support and resistance levels or short-term resistance levels or just single swings. And what you want to look for is a rejection of the level, and ideally you want to see that the candle and the market is piercing through whatever level that you have identified, and then within one candle, within two candles, very quickly reversing back and rejecting the level. You typically don't want to see a breakout, although there are cases where it can enhance the setup. If, for example, like here, you have actually a close above a high, and then within the next candle, you have a very strong reversal candle. But let's focus on what we are seeing here, and you can see that the market is in a very strong downtrend, and then we are reaching the previous support level. And what is going to happen here? A lot of traders who are short are probably going to take profits, which is contributing to bullish pressure. Also, a lot of breakout traders are probably getting into here, so selling more. Probably the people who have been missing a lot of those trending action here are then trying to get in short here. Their stops will be somewhere here, and then as the market reverses and is rejecting the level, the stops are triggered, and a stop on a short position is also going to contribute to buying pressure. So you'll often see that the market is playing around those previous lows and highs. There can be more than one rejection, and typically what you would like to see then is a momentum candle. Here you can see after the pin bar, then we'll have a momentum candle. The momentum candle also has a component of the pin bar, so we take out the lows once again, which is a very strong signal, a double takeout of a low, and then the same candle has also the momentum here in form of a engulfing candlestick. So it's completely outside of the past 1, 2, 3 candlesticks. So a very strong reaction. The market did move a lot in this candle, and it closed almost all the way at the high. The final piece to the puzzle, if you're then looking for a bullish move away from the level, you could wait for the market to actually clear the so-called flip zone. Previous support may be holding as resistance here. So you want to make sure that you don't get in under a resistance level. So you could wait for the market to actually get above this level and then initiate your long entry. And you can see the market in the candle afterwards closed above the long level. Here we have another rejection, which is another stop run, and then you can see afterwards the market is really nicely taking off. Second, I love the breakout buildup. I talked about this a few times in the past. I think it's a very great pattern. It's also a component that you can use for any other pattern, so it can be considered an add-on. So what we have here is the market is in a strong uptrend. You can see from the bottom left to here we are making higher highs and higher lows. Then the market hits a resistance level here, and we are seeing a bearish move. The bearish move does not break the last swing low, so we are not technically violating the uptrending structure, which is good. So we are still technically overall in an uptrend. And then the market returns to the previous resistance. But the most important thing is how the market is then reacting after reaching the highs. And you can see, whereas the first time we reached this high, the market sold off very strongly. It is in fact the strongest sell-off that we are seeing here in all of this uptrend. But the next time the market is reaching the level, there's just barely a move. The market is very closely staying here at the highs. And this, what does it indicate? It indicates a lot of buying pressure. It doesn't indicate a lot of selling interest anymore. Probably there was already a lot of buying interest, and when the market dipped here, the buyers got in here. And the most accumulation probably happened here at the last swing low. Then here, there is not more selling left. There's very little selling left. And then you can see the build-up. The market is really sticking to the level. However, we definitely always need to wait for the market to clear the high. So the final piece to this setup and the final piece to the puzzle here is you wait for a confirmed close above this level. Here you can see that we have a close and then we have a retest. So breakout and retest often come very close together, and then the market takes off. The dirty retest is a liquidity concept. I talked about this in the past, and it's a very important concept. Even if you don't end up trading the dirty retest, understanding about stop zones, liquidity zones, and stop runs is very helpful for your stop placement or just for general chart understanding. So what do we have here? We have the market in a downtrend, then we have the so-called triple tap, tap 1, tap 2, tap 3, which is a pattern that I will cover later in this video as well. And then we are building this pattern, which kind of looks like an inverse head and shoulder. We have here our neckline, the right shoulder, which is a higher low. The left shoulder probably somewhere in here. We also have the component of a double bottom. And also you could say maybe this the right shoulder of a Head and Shoulders sometimes also has the concept of a breakout buildup included. And what happens now? The market is breaking out, and a lot of breakout traders are probably getting into around here. Their stop is, depending on their style, somewhere in here. On the breakout, their stop loss may be about below the recent low, maybe below the absolute low, or maybe just very close if you're an aggressive trader. So the market takes off, and what are people going to do? They are going to move their stop loss to break even because they want to protect their stop loss, or so they think, or rather they want to protect their trade, or so they think. However, stop runs occur very frequently, and it's so obvious right now. Where are the stops going to be? They are going to be break even, they're going to be here, somewhere in this area. And what happens to free up liquidity? The smart money, the big players, are going to drive the price back into the zone. First of all, now we are just fishing for the real break-even stops, which are just here. And on the next push, we're going to get deeper and deeper until we find the real liquidity pockets. And then once we have found the liquidity pockets around here, you can see how fast is the market retracing. Every time we hit a liquidity pocket, you see a strong bullish impact. And that is the key. When you see that on the dip back into the pattern, you see afterwards a very strong bullish reaction, such as here or here, very huge candles. That shows you that there's a lot of buying going on, a lot of stops are being triggered here, and also probably a lot of people are going to get into the trade. You could then wait for the final piece, which is here. We have established a resistance level, and then once we get above it, you can see that's where potential entries could have been taken. But it's always important to ask yourself, where would other traders have their stop loss, and will they move it to break even, yes or no? And then just react on when the market is coming back to a previous breakout area, for example. How's the market reacting? Do you see strong buying going on? Then that is a very good hint. Flags are a very classic pattern, but if you read any of the classic price action books or books about technical analysis, they often reference flags as one of the most profitable patterns. And flags are trend continuation patterns. So what you do is you look for the overall trend direction. So clearly we are coming here in a downtrend from the top left, and the market is moving lower. And as we have talked about in the past, trends just don't move in one single line to the target. They go back and forth. And the flag pattern is going to help us to get into trend trades. Maybe we have missed the initial move of the trend, or maybe we want to add to our existing position. So what happens is you see that the trend direction is downwards. In a very short time, the market falls. And then we have a flag. The flag is the so-called consolidation. And the market moves up. It is going against the ongoing trend direction. One thing that is often common for a flag is that the angle is much shallower than the trend. So here you can see we fall very strongly in a short amount of time. So the angle is very steep. Whereas here the angle is not as steep. It's not very aggressive buying. And that distinction and the difference between how strong is the buying versus how strong is the selling is also helping us understand, okay, this is actually or could be a potential flag consolidation, and on the breakout we may go lower and resume the trend. What you don't want to see is a very strong flag pattern. So if the market rises very strongly, that's often not a very good sign, because it indicates actually either a lot of buying or a lot of profit taking from the sellers. And you can see after the flag was broken, we moved down very, very quickly. So you can see in a long amount of time, the market rose very little. Whereas here in a short amount of time, just a few candles, less than 10 candles, the market not only broke below the flag, but we continue to move lower. Then here we don't have a typical flag, but we have another consolidation. And here the market was not even able to go higher. Here we were just able to make equal highs. So whereas here in the initial flag we did have some upwards momentum, here the buyers absolutely had no say over the market. And there were only sellers, probably a few sellers getting out, more sellers getting in at the top. And then you can see the breakout candle, very, very strong. And then we resume. And again, when we resume, that is where the market moves a lot. Whereas in these consolidations, there's barely any movement. Triple tap, one of my favorite patterns. It's a very, very important pattern to note. And the triple tap can help you understand when are trends likely to end and to be over. And ideally, you want to look for a triple tap in an existing trend. So if the market has been trending for a long time and then you see a triple tap, that's where you want to really get interested. And basically, the triple tap just means 3 consecutive higher highs. However, each high is less and less strong. So we can see that the market was very strongly rising higher, and then from here to here the market barely was able to make a higher high. So that's already indicating a very weak market. Then from here to here, first of all, it took a very long time, whereas in a trend you typically don't see that the market takes so much time to move higher. Also, the distance is very long, so or very short here. From here to here, there's a very, very small amount that the market was only able to push higher. So this indicates weakness, a lot of weakness in a strong uptrend. Then you can see afterwards we have a lower high. So here the market was not even able to make or get above this high. So a very, very important additional piece to the puzzle. We see here, then the market is breaking the lows of the previous uptrend, and that's where the market really collapses. So the triple tap is the first sign, the lower high is the second sign, and then on the breakout, that's usually where breakout traders and trend reversal traders get in. Price divergences, they're kind of similar to triple taps, they just focus on a few other concepts, or we could say they focus on the same thing, but we're looking at it differently. So we're looking here at a downtrend, obviously, and we can see the downtrend was moving down here very, very quickly and strongly. There was almost no bullish opposition, right? The market just moved down. And then here suddenly we have a strong buying period. So the market moved higher, which it has never done during the past downtrend. So what happened here? Probably a lot of profit taking, people who were short, who got out of their trades, they locked in the profits, and then maybe a few people who maybe missed the trade or the trend then got in here on the next leg. But what happens? The next leg here seems to be much shorter, whereas here the market trended lower for a long time. Then here, for now, we don't see a lot of trending going on. And when we look ahead, you can see we are skipping ahead a little bit, and you can see very strong selling, then strong buying, which is something you don't want to see, and then a very short amount of time of selling only. So we cannot even compare this period down here. Maybe, how much is it? Maybe a fourth of what happened here. So a fourth only of the selling duration here. So there was not a lot of interest in selling. That's the point here. Not a lot of people wanted to sell after we got here. And then the market started to completely reverse and made higher highs and higher lows until it reached this point. So now we have really shifted our bias. I wouldn't say when we look at the market in this way, it doesn't look bearish anymore, right? I wouldn't say it looks really bullish either. It's more like a transition. We are going from downtrend to sideways range. So the market is in a transition period. It is between trending legs. And then the final piece to the puzzle is you would like to wait for the market to clear here this area. And what does this mean? It would mean that the market, if it breaks above this and if it closes above it, it's making a higher high, and it's also breaking out of the transition. And you can see how are we moving into this with higher highs and higher lows. We could make a case that this area here resembles also a buildup, whereas when the market was here the last time, we had a lot of selling. Now the market is back at the same level, but almost no selling is going on here if we turn around. And you can see this is what happens. We have a breakout and immediately a stop run and another retest, and then we take off higher. So the price divergence helps us to look at trend waves. How strong are different trending phases? Very strong trending, not very strong trending. And those little pieces of information really help us understand who is in control of the market, and is it likely that the market is going to continue lower or completely turn around. The 1, 2, 3 pattern is super nicely complementing the last 2 points, the triple tap and also the price divergence. So in a downtrend, you will see the market is making lower lows from here, a lower low, and so on. And we are making lower highs. Until here, now is the first time that the market is breaking a higher high. And what does it mean? So in a downtrend, what you will see that the people are selling, obviously, more than they are buying. And what they're doing, they're putting their stop loss above the previous high, typically. So as the market moves lower, they are locking in profits and they're moving their stop loss from high to high to high. And then once the stop loss is hit, and once people are forced out of their position, so people who are short have their stop here. And people who are short and executing their stop, that's buying pressure. And that could indicate here or could lead to more buying as well. And this is where the 1, 2, 3 pattern starts. The 1 pattern, the 2 is signaling our first move against the previous trend direction. So we are breaking the previous downtrend structure. We are making our first higher high. And from 1 to 0.3, we are making the first higher low. And then you can often see that the market is continuing into the 1, 2, 3, 4, 5 trend direction. So the 1, 2, 3 pattern, we are breaking above previous highs, is often an indication for a new trend direction. And of course, we could see that the 0.3 is coming much beyond what we have seen here. And that would then be also a dirty retest or could be a liquidity run. If we get here below that, that could mean we are testing a lot of stops as well. The flat top triangle, similarly to our flag, is a trend continuation pattern. And now you will see that we slowly are able to combine the different concepts and tools that I've shown you. And by the end of this video, I have prepared one special, very important tip. So make sure to stick around until the end to really master price action. And what we see here, first of all, we want to identify the trend direction, and we are clearly moving higher. Then we are hitting a resistance level. We have a high where the market is not able to push through, which is not a problem. This is very common. Probably people are taking profits here. Not everyone, but a lot of people are probably sitting on quite a good amount of money, and they are maybe taking some profits. And the key to the flat top triangle is how's the market moving lower. Every time we hit the resistance, we're moving lower. And here we hit the resistance and we move lower and so on. But the point is that even though the market moves lower, we are never making lower lows. We are always staying here above this trend line, or at least within the trend line. So even though the market is selling off, each sell-off is less and less strong. So this has components of the breakout buildup. If the market, or when the market is not able to pull away from a level where it has previously shown a strong reaction, that is a good indication that they may be building a lot of pressure. And then you can see we have the breakout. Here a lot of breakout traders will get in. Then they will be very happy about their profits when the market is here. As we are building the double top, probably a lot of traders are moving their stop loss to break even, and then that's where you see the stop runs. So I would really recommend to, if you have problems with breakout trading, think about your stop loss approach. Are you moving stops maybe too soon, too aggressive? And is the stop run having problems or creating problems for you? And are you often frustrated because you are able to anticipate the overall direction correctly, but your trade expression is not working out? Then I would also recommend to really think about your stop loss movements. Deceleration, one of my favorite topics, because it is very simple but powerful. So what do we have here? First of all, we have a supply zone, and I will come back to supply and demand trading in a moment. And supply zones often exist at the beginning, early on in downtrending markets. So in here we have a supply zone, and the market dips into the supply zone again. And then we have the concept of deceleration. We have a strong bullish candle, and afterwards we see that the candle size is decelerating. It is getting smaller and smaller. That's a very important point. If you look at downtrends here, for example, or healthy downtrends, you can see that the candle size is decreasing a little bit, but not in a significant way. Whereas if you see that after a very strong candle, the candle size is decreasing significantly, that's an important finding here as well. After the market pushed lower, you can see the next push was followed by a very small inside candle, and then that's where trends reverse. So the deceleration, not necessarily I would say is a time to go short, but it's a first heads up. And what I would recommend, when you see deceleration at a location, at a level, support resistance, supply and demand zones where it makes sense to see a turnaround, then we drop to a lower time frame. So now we are on the 15-minute, whereas we saw the deceleration on the 4-hour. So 15-minute time frame, and here we can see that's a triple tap probably. And also we have a nice pattern. We have a nice support level where we could use a breakout approach. So if we get a breakout, that is where we could, for example, look for a short opportunity. And this is what happens. We have the breakout, and then here we have the dirty retest. So very, very interesting scenario. We can combine 1 to 3 patterns. We can combine breakouts. We have our stop run concept, and we have the higher time frame deceleration, which we are now slowly able to put together in very, very meaningful ways. Now we come to the supply and demand zone, and this is a supply and demand indicator that is coming from Pattern Alpha, and we are also behind Pattern Alpha. If you want to learn more about the automated supply and demand zone indicator for TradingView, check the link in the video description as well. It automatically finds the best supply and demand zones for you across all markets, across all the time frames. And the way you want to approach this is identify strong supply and demand areas and then wait for the market to get there. You can see this is the zone that we have identified, and the market comes back to it, and it's deceleration. Here, for example, there's also a supply zone, but there was no deceleration. You can see that the market moved higher, and then the next candle was a continuation. So we don't just trade supply and demand zones blindly, which is very important for any topic and any concept, whether you use support and resistance, whether you look at the previous highs and lows. You never trade them blindly. You always want to wait for some other type of confirmation or signal around it. Here, now we have the signal. We have deceleration. You can see that the market slowed down significantly. And now we could, for example, go to the lower time frame, 15-minute. This is how the deceleration looks on the lower time frame. We have here a double top, lower highs. We have the breakout, and that could be your entry, or if you wait for a stop run, you can see it happen afterwards. A lot of selling going on afterwards, very, very strong reaction here. So very interesting study, and we can slowly start putting things together. The engulfing momentum candlestick is a very important signal, and the way you use it is you identify it on a higher time frame. For example, here we have an engulfing candle on the daily time frame. It's happening at a demand area, which is inside here. And the engulfing candle is showing you here a momentum reversal. We are coming from a very strong selling sequence. We have little parts of a deceleration after strong bearish candles. The bearish candles getting smaller. Also, this is what I call, or what is called, the void. And in Forex, we typically don't have big gaps, such as in stocks, for example. But this is resembling a gap in Forex. And once you cover those big moves, then there's often a lot of demand waiting here at the bottom side. And it makes sense to look for a reversal here. So once we see that, we go to the lower time frame, and here we can see we have here a rejection of the lows. We have a fakie, and then we are back at the previous highs. And you can see we have our breakout buildup, we have our dirty retest here, and then once everything is cleared, we really take off. So this is a beautiful multi-time frame analysis. We have our higher time frame bias, we have our lower time frame fakie, we have our buildup here, we have the